Hi, it's Wednesday, June 15th, 2016. Maneko 64 here, home of alternative economics and contrarian views. It's very early in the morning here in London, but I just finished listening to a very interesting and important interview, in my opinion, or emergency broadcast by Jim Rickards. He was interviewing a very well-connected and important person in the physical gold market in Switzerland. He had to hide his identity because he works very closely with the major players in the physical wholesale gold market. So Jim Rickards called him Goldfinger for this emergency broadcast. Goldfinger explained that Switzerland sees 70% of the physical gold flow every year, as it's got the biggest and most important refineries. Gold has been flowing from west to east the last 5 years, especially to China, from Western central banks to China, India as well. But he said China is really the big buyer. And the other interesting thing that he said is that in 2016, the Chinese have actually pulled back their buying, mainly because they don't like chasing the market, and the market has gone up 20% this year. But he actually mentioned that the West now is starting to buy, which is a complete, shift, because the West has been selling, and he said there's been 250 metric tons of demand from the GLD trust. So that's the major important factor he sees, is that the West has gone in back into the gold market, physical gold market. And my opinion, the reason for that is all the zero interest rates, the negative interest rates. The West is finally waking up to the fact that gold is actually a high yield asset in a world of negative interest rates. He didn't mention that. That's my view, and I think that's why this is happening. But what he's saying now is that if the Chinese just pick up their buying to the kind of quantity they've been doing the last 2-3 years, this could be the trigger that could drive the gold market higher, above 1,300 and towards even 2,000 or a new high very soon. So that's what he thinks is the could be the trigger. And the other point that Jim Rickards and Goldfinger made is that right now, if that were to happen, the mining industry would not be able to cope with the demand, because we've had 4 years of bear market and a lot of mines have closed. So it would take another 5 years to match that demand. The other, so that's Dory gold, they called. So there's very little gold coming from mines, and a higher price would not increase it, because there's been disinvestment in the mining sector the last 4 years. And the other point he made is that the Chinese and the Indians and the other central banks are not going to let go of their physical gold. So the only thing left would be scrap gold, which is like, small, not small investors, but just, the regular person in the street selling their jewelry. And, that's going to take a lot higher price for people to do that. So Jim Rickards and Goldfinger actually think that we are on the cusp of this trigger that could get the gold market to go crazy, mainly because there's a lot of physical demand now from the West. And Jim Rickards says that he feels that the FOMC meeting, which started on the 14th yesterday and finishes today on the 15th, could be that, spark under the gold market. And he points out that the Chinese, they need to be, well, actually Goldfinger said that because he knows the participants. He feels that the Chinese need to feel that we've got a bottom in the gold market right now, and that it, these levels where we're now at 1280 is support for them to come back in, and that will just really put a rocket under the gold price. Jim Rickards thinks the Fed has put itself basically in a corner the last few years, because it keeps going, we're gonna start raising rates, we stopped for forward guidance, we tapered, and up until before non-farm payroll earlier this month, everyone expected to raise rates today, the 15th, and there's no chance they're gonna do it. So he thinks that it will really be important to listen as well to the press conference, which is starts at 2:30 New York time, 2:30 p.m., 7:30 London. They announced the decision on the rates half an hour before at 2 o'clock New York, 7 p.m. London. So he feels that at the press conference as well, Janet Yellen is going to be dovish, and that's going to get gold going up, and that will be the signal, according to Jim Rickards and also Goldfinger, who's keyed in to Chinese way of thinking. That will be the signal for the Chinese to go back in, and they expect gold to go above 1300, and that will be the trigger. And Jim Rickards says that even if Janet Yellen is hawkish during the press conference, that will help gold, in his opinion, because it's going to hurt the stock market. The stock market will drop quite significantly, and people will go into gold. So he thinks, this move, this shock in the gold market could be, here, right now, after the Fed meeting, and he thinks that could be a big trigger, because it will reassure the Chinese that they need to get back in and start buying, the kind of size they've been doing for the last 2-3 years, and coupled with the heavy demand now coming from the West for physical gold, that will be what will put a rocket under the price of gold. He talks about $10,000 gold, but that's not for, tomorrow or the next few months. That's more in the long term. So the really important point about this emergency broadcast, as Jim Rickards calls, is that the physical market is really tight. And with the West now getting involved after many years of selling physical, we just need to see the Chinese get back in, and that could really get gold going. And the other point that the Goldfinger made is that with gold, the higher the price goes, the higher the demand goes. So it could really be something of a shock in terms of gold price. So yeah, I hope you enjoyed this video. Please like, share, and subscribe, and I'll talk to you later. I'll probably be going to bed now. It's let's see, it's just 1 o'clock in the morning here, but I thought I'd let you guys know what Jim Rickards and Goldfinger had to say. And take care, and goodbye.